There is absolutely no denying that Netflix just turned in one of the best fiscal quarters in its corporate history, surprising a lot of Wall Street for all the right reasons. Following the closing bell on the New York Stock Exchange, Netflix released their quarterly earnings results, and you can see the results right there in the after hours trading. This thing exploded by over 12%. Now, certainly, we do not give financial advice here on Valiant Renegade, but we are observant of what the reactions are to such an earnings report. And we're going to go through some of the details today of what made Netflix's quarter so good because, well, we cover the entertainment industry. That's what we do here. But of course, there's the other side of this, and that is, what does this mean for the Walt Disney Company, who is set to report their earnings in just about 3 weeks from now on Wednesday, November 8th? Well, if Disney is looking at the Netflix earnings call today and the exuberance in the reaction from Wall Streeters out there, I think Disney had better be really nervous right now. Let's talk about that. Here we go. Online. Well, folks, welcome back. Another great day here at Valiant Renegade. It's good to see everybody out there once again. And if you are like one of the many folks watching this video, not yet subscribed to this channel, please take a moment and turn that little red subscribe button to gray. Hit that like button, hit that notification bell, share this sucker out on the social medias, and of course, please do leave a comment before you head out the door today. Make sure to join us every Sunday afternoon at 6 p.m. Eastern U.S. Standard Time for the live show. And we're going to have one this week, speaking of Disney, as we mentioned in the intro, because Disney recently filed an entire restructuring of their accounting and reporting systems ahead of that November 8th earnings call. Something that we knew coming into this fiscal quarter that Disney was going to do. It was only a matter of time before they put that out there. But that is a very, very lengthy 8K filing they did with the SEC, the U.S. Securities and Exchange Commission. We will cover it in great depth on that Sunday live show. Stick around for that because, again, this Netflix earnings that we're about to talk about is going to play big in terms of how these same Wall Street entertainment and tech analysts look at Netflix and then what their expectations are going to be for Disney in that November 8th earnings call. We'll have a video that also talks about some of that ahead of the Sunday live show, so stay tuned for that as well. It was one heck of an afternoon after Wall Street closed with articles like this saying Netflix CFO says the company has a long runway of margin growth as streamer hikes prices. Yes, Netflix is raising prices. And no, Netflix is not scared about raising prices whatsoever. They've obviously done the research and they know that their model has a lot of price elasticity, maybe more than Disney has right now, maybe more than what Disney was used to in the past, but certainly going forward. And Netflix knows that they can keep stretching these premium price plans out. In this case, the high-definition plan, let's call it, is going to go from $10.99 to $13.99 a month. And then the 4K plan, the ultra-high definition, is going to bump up $3 as well to about $22.99 a month. Netflix doesn't care. They know the vast majority of users are going to stick around, and that even if they lose a few subs based on those price increases, they're still going to net out in higher revenues in the long run. Not to mention the fact that their ad-based tier is going to stay where it is right now at about $7 a month here in the US. And Netflix really wants to get more people into that ad-based tier. The password sharing crackdown has been a rousing success for Netflix. They added about 1.7 million subscribers in this fiscal quarter, just in North America alone. Nearly 9 million new subscribers globally. We'll get to those specifics here in just a moment. But let's look at some of the highlights here from the Netflix earnings call today, which we covered live. We watched the Netflix drop of their earnings call that they do typically every quarter on their YouTube channel, or at least their Netflix Investors YouTube channel. But here we have our Q3 financials were in line with to ahead of forecasts, with revenue of $8.5 billion, paid net additions of 9 million, that's 9 million roughly new subscribers, and operating margins of 22.4%. That is staggeringly Good. When you look back at Netflix of just about 6 or 7 years ago, that operating margin was about 5 to 6%. You can see the kind of growth that they've had. And Netflix says we are now expecting an operating margin of 20% total for the fiscal year of 2023. That would be at the close of this calendar quarter as Netflix's fiscal quarters align with calendar quarters. So that'd be December 31st. New Year's Eve of 2023. Cutting through the weeds, here is the bottom line. Netflix is forecasting a year-over-year growth. You can see on that second line beneath revenue of 10.7% for the Q4 2023 forecast. That's a heck of a climb for any company out there. Netflix is obviously doing something right. And sure, we can lament some of the shows that Netflix is putting out there, saying they could have done a much better job with things like The Witcher, or even some of the previous live-action anime adaptations like Cowboy Bebop, but they have had some tremendous successes. More successes than fails at this point, at least in the past 12 months. Just look at recent entries like One Piece and how big that was. Matter of fact, Netflix had a lot to say about One Piece during the earnings call interview.
This past quarter, we had this really remarkable story about something that we could do. But Spence talked a little bit about the kind of scale of the content spend. But this show, One Piece. One Piece is something that is a very unique property. It's created 26 years ago by Kira Oda. It is over 1,000 episodes of the animated series based on the Japanese manga. It's nearly sacred IP. And we were able to, with our Japanese creative teams and our American teams getting together, partners at Tomorrow Studios and the showrunner Stephen Maeda, to adapt this into a show that the world fell in love with. And when I say that is we've got, this show is #1 in 84 countries around the world, cool. Which is something that Stranger Things didn't do, that Wednesday didn't do.
In fact, the only real dire news for Netflix seems to be that the average revenue per member, or what we more commonly refer to here on Valiant Renegade as RPU or ARPU, average revenue per user, they call them members instead of users, decreased about 1% year over year. But that was mostly due to the fact that the largesse of their increases in subscribers came from international territories where the ARPU, or ARM as Netflix calls it, is naturally lower due to foreign currency exchange rates or just the general state of the economy. Think of how Disney deals with Hotstar in India. Disney charges about 1/10 in India of what they charge here in the United States for a Disney Plus subscription. So too is the case with Netflix, although of course Netflix does not have any significant exposure in India. But one of the high points of the Netflix earnings call is frankly how free-willed and engaging and frankly upbeat these Netflix executives tend to always be when you hear these earnings calls. You've heard us talk and cover earnings calls from places like Disney before, which seems to be far more subdued, mundane, of course, unless some wild questions get asked or Disney reports some very dire news. But typically those are very scripted and very flat. Netflix earnings calls tend to be far more off the cuff and engaging. It's more like a conversation. And you know what? The CEOs and the CFOs there at Netflix, they're just happy to be doing what they're doing because they know they're moving in the right direction. Let me show you what I'm talking about. Let's take a look at the actual financials reported here by Netflix. Now, don't let this be daunting to you whatsoever. We'll walk you through this. But what I want you to take a notice of, yes, this is the actual financial documents that they provide in public filings to investors. It's not a pretty PDF with 37 pages. No, Netflix just makes a straight up Microsoft Excel spreadsheet, or, if you're a Mac user like me, a numbers spreadsheet. And this is what we're looking at. And I think it's brilliant. I love just looking at the simplicity of this. But they give us a backstory here for Netflix's revenues back through 2021, 2022 right here, and then 2023 year to date, which is only 3 out of the 4 quarters, of course, because we're not to the end of the year. Netflix, again, does not follow a fiscal calendar like Disney that ends on September 30th. Their fiscal calendar lines up with the typical natural calendar that we have from January 1st to December 31st. But look at 2022. This is total revenues for the year and then total operating income. We're going to focus on those two numbers for right now. Look at the revenues in 2022, $31.6 billion. I want you to look at the total revenues year to date, which is just 9 months worth, 3 quarters versus 4 quarters in 2023. almost $25 billion. And if you look, about $8 billion quarter over quarter, $7 to $8 billion, almost $8 billion quarter over quarter in 2021. So you've already can see that they've had a good bit of revenue growth this year. Now, let's go back here and let's look here down at operating income, this line where you see my cursor swirling here, and let's move over because this is what's really fascinating. Look at the total operating income. This is basically a measure of profit, $5.6 billion total for the year ending December 31st, 2022. $5.45 billion in 2023. That's only 3 quarters, not 4. That means that Netflix overall profitability this year is going to be sharply higher than it was from last year. This is how well they're doing. Let's take a look down at another line right here. Net income. This is after they take out other things that are non-operating things that don't, fall under the category of paying to produce a television show, for example, or paying for all of the technological infrastructure that runs the Netflix platform. Let's look here. When you take out other things like interest expenses, what is the income before taxes? What do we get here with net income? Look at this, $4.49 billion total in 2022, $4.47 billion in 2023, and we don't even have the fourth quarter yet. Everything Netflix is doing right now from a pure business standpoint is working for them. This is vastly more than we can say for Disney with regards to Disney Plus. Throwing out, of course, Hulu and ESPN Plus for a moment, but their big headline ticket at Disney, of course, is Disney Plus. Now, when you look at Netflix, and sure, we can complain about some of the whiffs that they've had with major properties. And I understand that there's people out there that don't like Netflix because of what happened with Henry Cavill and The Witcher. I totally get it. Or some of the other shows they've done, live action adaptations of animes like Cowboy Bebop that were huge flops. But they're starting to get things right. And you look at things like One Piece, like we talked about earlier, and Netflix is trending in the right direction. They're a highly profitable streaming company. And this is what Wall Street is going to use as a metric by which to compare the performance of Disney Plus, something that we're expecting to see on November 8th in just 3 weeks from now. Now, the other side of Netflix that's working for them, or that is fixing to expand to work even better for them, is their advertising tier. Now, just as places like Disney Plus are growing an ad-based tier, so too is Netflix. But of course, Netflix has far, far less experience than the Walt Disney Company does in this venue. Disney, of course, has been selling advertising for decades on end, especially with all of their cable channels and their acquisition of ABC some 25 years ago, which is what brought Bob Iger to Disney in the first place. We're sorry. But Netflix is seemingly very energetic about their downrange prospects for this advertising tier. And what they're suggesting as of today's earnings call is that somewhere around 30% of all the new accounts that are signing up for Netflix right now are signing up for that $7 a month, at least in the US, advertising-based tier. And certainly a lot of these new accounts are probably coming from that password crackdown, but it's working for Netflix. And this is the thing in business. For all of the whining and complaining about, I don't want ads, or I shouldn't have to get my own account, I should be able to stay on my aunt's account who lives 5 states away. You know what? It doesn't matter. Netflix did the research. They knew most of these folks were going to sign up for their own accounts. They want more people on the ad-based tier. If you don't like paying $23 a month now for your 4K subscription like I have with a family of 5, that's fine. You can back down and go to the cheaper tier with ads. And the ads usually are fairly unobtrusive when it comes to shows. You might get a couple that run at the beginning of each episode, but that may be about it. But the point is, with Netflix and like most other streamers, they know eventually the industry is always going to return to form. And that is to say simply this. Think back 40 years ago, if you're old enough to remember, when cable television first came around, what was the allure? There was no advertising, right? Well, over the last 40 years, your cable subscription fees have gone up through the roof. And guess what? So too has the advertisements on every channel on cable, except for things like premium stations, Showtime, HBO, Cinemax, Stars, Encore, etc., etc. Now, the thing is, that's going to happen with streaming too. There's no getting around it. advertisers will come back in. They already are there. And whether you like it or not, that is going to continue. Now, certainly because of the more modern audiences, and by that I mean the ones that are used to not having commercials on streaming services now for, say, the last 7 or 8 years, there will still be a plan for you. But don't be surprised if in the next 5 years your Netflix plan is going to rise to somewhere close to $30 a month for you to maintain it without those ads. And that's because they'll be able to sell a $7 to $10 a month ad-based tier and still make more money on those subscribers because of those ads than they do on your premium subscription. Netflix is unequivocally winning right now. Now, that doesn't mean it's going to last forever. That doesn't mean that things couldn't turn very sour in the next quarter. We don't know. All we can look at is what does the public data tell us right now? They are doing very well, and Wall Street obviously is very excited by it. The question now is for Wall Street, Disney, what you got? We'll find out November 8th. Make sure you join us for that live show covering the Walt Disney Company earnings call. We've already got the stream set up, so you can go turn on those notifications right now as we close this video out. Thanks for joining us, and until next time, take care. Make sure you're subscribed to Valiant Renegade and join us every Sunday at 6 p.m. Eastern for the live show.